I've heard this over and over. I want to retire, but I feel like my only options are to keep going 100 miles an hour or stop altogether. Stopping altogether makes me nervous because I feel like I won't have any form of income or any ability to do some of the early tax planning goals that I really want to do. Secondly, I'm afraid if I take early Social Security that I will blow up my entire ability to do Roth conversions and any sort of tax planning. Today's video is going to show you how both of these things are short-sighted and how it's never been a better time to fade out of work. When I have these conversations, I often realize that people want a break from a job, not work. Work brings us meaning, it gives us community. A lot of people love working, and when we really dig deeper, we realize if we were able to work part-time, even part-time for several years before actually retiring, that would bring a lot of peace of mind and a lot of joy. So I'm going to show you how the shift to part-time work prior to retirement can still help you meet the goals you may have around tax planning and Roth conversions, and you can do it in a tax-efficient way. If you're new to the channel, I'm Forrest Dutton. I am the owner of Brightworks Financial Planning. I'm a certified financial planner. This video is for education. It's to help you get the most out of retirement and do it with confidence. It's not meant to be personal, financial, tax, or investment advice. So without further ado, on to the rest. Okay, let's talk through today's case. So let me start with the assumptions. We're going to assume that this person is married filing jointly. I'm going to kind of make some notes here. So we have a married filing jointly. We have age 62. So what I'm going to assume here is that we have client 1 62, client 2 62, and really what they're thinking is we want to completely retire at 67. Now in this case, I'm going to assume one spouse is actually already retired. So this would be a great scenario for one spouse that wants to work part-time while the other spouse is already retired to kind of ease into retirement. So that's kind of where we stand. We're also going to make an assumption that there is a brokerage account that has at least $500,000. That would work the best for this scenario. Now, why a brokerage account? Now remember, I want to draw your attention to the fact that when you get to retirement, often your taxable income is going to determine how capital gains are taxed. For most people, they're at 0% or 15%. There are some that are going to be at 20%, but that's usually not applicable in retirement. So in this case, what you want to do is you want to take withdrawals from that $500,000 account and take advantage of what's called the 0%, I'm going to say capital gains bracket. And basically that means if there are long-term gains, securities in that brokerage account that have been held for 12 months or more, when you take those out, as long as your taxable income is under a certain amount, in 2026, it's going to be in the high 90s, right? So if your income is somewhere around 98,000, that is not exact, okay? This is just for illustrative purposes. You would need to get the exact number from your CPA, but around 98,000 is up until that amount. If your taxable income is that or less, if you are creating that taxable income through distributions from your taxable brokerage account, it will be at 0%. So with that out of the way, I want to make one more caveat here. In the brokerage account, that is an account that you contribute to. Your employer doesn't make contributions to it, you own it. So the money that's in there is a combination of money you put in and growth from whatever's in there. It could be stocks, bonds, money market accounts. So in that case, you're going to have what's called a cost basis. I'm going to assume that of that 500,000, 250 is your money and 250 is growth. Okay, so another way to say that would be when you make a distribution, only about half of it is going to flow through as a long-term capital gain. The other half of it would be considered a return to you. Again, not how it actually perfectly works in the real world, but for our illustrative purposes, it will do. So the reason I'm bringing that up is I want to draw your attention to some line items here. So what we have is just a situation that helps us plan for taxes when it comes to distributions, when it comes to retirement. Again, does not replace your tax preparer. And this is something that I always discuss with tax preparers of clients, but it's a great software that helps us come up with some planning scenarios to discuss with the team. So in this case, what we're looking at is I'm looking at a couple that wants to live on $120,000. And I'm about to show you how we came up with that 120,000, and then I'm going to show you how living on a little bit less might be more advantageous if they want to implement some tax planning and Roth conversion. So what I first want to address here is, how does a Roth conversion impact taxation of Social Security? Now, this is pretty easily demonstrated, but before I get to that, I'm going to show you how I got this 40,000 number. So assume that from our brokerage account, we actually took out $80,000. So that's part of our living income. So we actually withdrew $80,000. That's what hit our bank account. But what flows through to the tax return, remember, by way of long-term capital gains, is $40,000. That goes back to our conversation around cost basis. That's how that $40,000 got there. I am assuming we do a $30,000 Roth conversion in this year, so that's going to come forward as income. I'm assuming that this person has roughly $50,000 in savings. That's where this $1,500 taxable interest came from. I just got that at a 3% rate. That's going to be variable depending on where you have your savings. But that will come back to cash in a minute. That's why I included it in the case. Wages, assuming again, this is part-time income. So they work and they make $40,000 on a part-time basis. So if we do the math, we're basically living on $40,000 plus $80,000, that's $120,000. Now in terms of tax, there are going to be things that come into play. So our total income is going to be $111,500. Now again, that doesn't perfectly map out the 120 that we mentioned, and the reason is because of things like the capital gains. But the point here is, from that income, we're going to then take a standard deduction so that our taxable income is roughly $80,000, a little bit less. Again, the numbers don't matter so much, it's the principles, okay? Because this isn't specific tax advice. You would have to run this by your tax professional. I just want to show you how these things operate and work together by way of education. So your total tax in this situation would be just a hair over $4,000. You are still in the marginal tax bracket of 12% on that conversion that you made. Now, what's important here is this is without Social Security. So I'm going to do the exact same conversion with the same exact income, but all I'm going to do here is shift from wages up here. Notice on this second column, this is called convert with social. So I'm just going to assume that instead of working for $40,000, that you get a combined $40,000 in Social Security. So again, we're assuming age 62. You could do this for yourself and spouse if you want, assuming that you're combined at $40,000. Now, why does that matter? So there's a misconception here that this is always a bad thing when it comes to tax planning. I don't necessarily agree with that, because in reality, this line here basically says, because of our Roth conversion at $30,000 and because of our Social Security, there's a way that taxation of Social Security works where it's usually either going to be 0%, 50%, or 85% taxable. That's how we got that 34,000 number. Basically, 34K equals 85% of 40K. Okay, not hard to see. Okay, so that being said, we actually run the numbers here and we scroll down, and if we do the exact same conversion and we're taking Social Security, we actually pay less total tax. Why is that? Again, because no matter how you slice it, even though it's still taxable, Social Security is still tax advantaged income. So don't get hung up by that 85% number. That's, again, like you worked, and instead of $40,000, like you contributed to a retirement account and that came off of your income, and when you go to your taxes, you actually report less. It's the same principle. So taking Social Security does not kill your opportunity to make Roth conversions. I just want to make that clear. Now, in reality, if you have a sizable enough brokerage account to live off of it, in most cases, you may not consider taking Social Security. Again, everybody's situation is different, but what I want to show you now is, what if you're someone that said, I want to work part-time, I still want to get more money into Roth and do some conversions, but I'm not sold on aggressive conversions. I want to keep them very mild, but I also want more Roth money. There is a way to do that. And so what I'm describing here is, this is a situation where I've got to roll back a few years. Okay, so there was an act called the Secure Act 2.0. Okay, so this came out in 2023. And you may be asking, Forrest, why are you saying this? I thought we were talking about Roth conversions and working part-time. It has nothing to do with it. Well, actually it does. So there was a provision in that act that overhauled what employers are required to include in terms of their 401k participants. Now before, if you were a part-time worker, you were not going to be eligible for a 401k. Now they've introduced what's called a part-time long time. So I'm going to call this PTLT. So that means if you worked over 500 hours for the last 2 consecutive years, then you would then be eligible for your 401k. Okay, well, why are you talking about 401k? This makes no sense to me, Forrest. Please get to the point. Okay, I will. So basically, what I'm saying is if you're somebody who says, man, work is really a drag, I think I could work part-time, but full-time is killing me. There's never a better time, because now if you make that jump prior to 2 years, let's just use a hypothetical scenario here. Let's say your spouse continues to work and you live on their income and your part-time income for a few years. That should be pretty easy, especially if you get to be late 50s, 60, and you feel like your debts are gone, you paid off your house, whatever it may be. That may give you some peace of mind. If you do that, then in that 3rd year, you could then be eligible for the 401k. And why does that matter? Because if you have a sizable brokerage, you basically have 2 options. You can just live on that money and you could decide to not work part-time. But if you were working part-time, what you could do is you could take out that 80K and decide, you know what, we're going to do a little bit of tax planning. I know we can live on 120 because spouse is retired. The only income coming in at this point is going to be the part-time income at $40,000 right here that I've got my cursor over. But in this case, over the last few years, we've really overhauled our cash. So this $3,000 represents taxable interest from a hypothetical $100,000 savings account, okay? So let's say we have $100K in the bank. We want to live on $80K. So this is our expense number. I'm just going to give you the numbers again. Cash, $100K. And then remember, we have $500K brokerage. Same principles, okay? So we still got that going. Now, what's next? So what you could do is you could take out the $80,000, live off it, and decide to defer on a Roth basis your entire salary and catch up, which in 2026, $32,500. So you're putting that into Roth. Now, I get it. You're taking money that you may pay 0 tax on now and potentially pay 0 tax on in the future, but at the same time, you may have pre-tax accounts, you may have some other things that you're concerned about when it comes to required minimum distributions, but you don't want to be too aggressive. So in this case, what you do there is you're still getting into a Roth 401k, $32,500 a year. Let's assume you're age 62. You started part-time work when you're age 60, so you can meet the 2-year rule. You enter the 401k and you know you're going to work till 67 because you want to delay Social Security, because you want to make sure for other reasons that for whatever reason you like that better. In this case, $32,500 per year plus $30,000 per year of Roth conversions, and you're doing that over 5 years. So if we add that, we're getting over $60,000 in Roth. How much are you paying for that? This is where I want to show you. Now, this assumes you're willing to live on $80,000, which, if your debts are paid off, still very doable. The only thing you'd have to solve for here if you had not a working spouse would be healthcare, which would be a totally different video, but hopefully you're following me. So you would live on the $80,000 that comes out of here. So what is your actual taxable income? So it is, your total income is $113,000. You have the standard, it's $80,000 of taxable. Now it's $4,400. Now, why did I mention cash? Here's the deal. If we look at this marginal bracket is still 12%. So you may say, well, you still paid 12% on the conversion. I would say that's wrong, because if you have cash that's $100,000 and you're not living off of it. Now again, there's an argument that says, why don't we just live off the cash? Totally valid, and I'm not opposed to that. You could do that, and this would make this even better. But if that $100,000 earns $3,000 in a year, you're basically just taking what you earned and giving it back in the way of taxes, plus about another $1,000. So this effective tax rate of 5.4 becomes even lower. It becomes somewhere around 2%. So that's amazing. So you're getting $60,000 a year in moved over to Roth, essentially paying that, right? Because you're already getting your wages. You're just living off the money that you took from the long-term capital gains. Now, there's another way to do this. What you could do is, instead of these wages, you couldn't decide to retire, because I want to be clear. If you think you have an RMD problem, then what you could do is you could work on even less and start taking withdrawals. You could turn that 40 into 20 and 20, right? So you've got 20K of part-time income. You got 20K of IRA withdrawals. You're old enough, you're over 59 and a half, you can do it. So that's another option for you if you were concerned, because remember, a conversion problem in most cases is people that are concerned about required minimum distributions. Well, what's one way to mitigate that? Another way to say this would be slow a speeding train, spend the money, right? And you're not going to be in a high tax bracket here, right? So why not spend it and live on it and enjoy your life in your early 60s? So again, this is just a way to kind of start to put the pieces together. And I hope you enjoyed this. Again, it's meant to be educational. It is not personal advice. Everybody's situation is different, but when I find people make these decisions, they make them in such a silo that it's a binary. I can either do this or that. In reality, all these things work together. If you know how they play off of each other, you can make the appropriate decision for you on what is right. Now, I want to be clear here. This is a scenario that is probably not applicable to those that have very, very large balances. In that case, in tax-deferred accounts, I would probably go ahead and encourage you to retire early and spend the money, because that would help you, again, spend it, withdraw it at a lower rate. Again, that's the whole point of conversion. You deferred it when you were working, and I find that a lot of people forget that. In order to have a sizable tax-deferred IRA, 2, 3, 5 million, you had to earn enough income to save that over your lifetime. So say you deferred in the 32% bracket and you take it out and it ends up being the 24% bracket. Well, you still won, right? You took it out lower than when you deferred it. So we tend to we have this bias of we only remember what's right in front of us, when in reality, the whole working years you benefited from deferring those taxes when you were working at a higher rate. So hope this was helpful. Please like and subscribe. What are your comments? I'd love to see what was helpful about this video, what you'd like to see, and if it helped answer some of the questions that you have. I will see you guys on the next video.